Imagine a single private banker stepping in to stop the collapse of the entire US economy not once, but twice. Long before America had a Federal Reserve, before the phrase too big to fail even existed, one man's name alone could calm Wall Street's panic: Morgan. At his peak during the Gilded Age, JP Morgan controlled more money than the US Treasury itself. His signature could shift millions in gold across the Atlantic overnight, rescue a sinking national currency, or decide which railroads and sometimes which industries would live or die. Newspapers called him the man who owned America. But how did one private citizen come to hold such power in a democracy? What secret network of banks and investors allowed him to rescue and sometimes profit from saving the nation? And what price did the country pay for relying on a single man to keep its markets from collapse? Let's dive in. The story of the Morgan Empire doesn't open on the bustling floor of Wall Street. It begins quietly. In 1837, in the riverside town of Hartford, Connecticut, the year a boy named John Pierpont Morgan was born into a household that already understood the weight of credit and capital. His father, Junius Spencer Morgan, was a stern New England banker who believed in discipline, thrift, and building ties across the Atlantic from the start. Young Pierpont wasn't being raised just to earn a living, he was being groomed to inherit a legacy of finance. Yet his childhood was shaped by two opposing forces: privilege and fragility. The privilege came in the form of a world-class education, Boston classrooms, the English high school, finishing in Swiss academies, and at the University of Göttingen in Germany, where he studied mathematics and learned German that would later charm European investors. The fragility came from chronic health problems, brutal seizures, recurring skin infections, and a disfiguring rhinophyma that made him painfully self-conscious. That tension, outward polish versus private vulnerability, forged the guarded, calculating temperament that rivals would one day both fear and respect. Morgan came of age as the United States itself was transforming. The Industrial Revolution was stitching the country together with railroads, telegraph lines, and steam-powered mills while the nation inched toward the Civil War. For a sharp young financier, that mix of industrial expansion and looming conflict promised both danger and opportunity. In 1861, at just 24 years old, Morgan launched his own New York firm as the American agent for his father's London banking house. One of his first deals, and one of his most controversial, came that same year. He bought surplus rifles from a U.S. Army warehouse at a bargain $3.50 each, then resold them to the Union Army for $22 apiece. Newspapers howled about war profiteering, but the profit seeded Morgan's first serious capital base. It also revealed a pattern that would define his career: spotting inefficiencies, moving fast to exploit them, and standing firm through the backlash. The scandal made headlines, but for Morgan, it was only the opening move. Within a decade, he would set his sights on a far bigger prize: the iron rails that were binding a young America together. By 1871, Morgan's growing reputation as a shrewd negotiator earned him a partnership with Philadelphia banker Anthony Drexel. Together, they created Drexel, Morgan & Co., a transatlantic powerhouse that connected old world capital to America's roaring railroad expansion. The alliance opened doors to British and continental investors eager to fuel the New World's growth. Behind the image of the unshakable banker was a man who knew loss. His first wife, Amelia Sturgis, died of tuberculosis only months after their wedding, a tragedy that drove him even deeper into work. The grief, combined with his ill health and stern manner, added to the air of mystery that would follow him in the press for decades. From the heartbreak of Amelia's death to the booming steel rails of the Gilded Age, Morgan's focus would sharpen. The next chapter of his story isn't just about banking, it's about how one man would learn to control entire industries. From these beginnings, privilege and illness, wartime opportunism, and global connections, Morgan laid the bedrock of what would grow into one of the most powerful banking dynasties in American history. When J.P. Morgan returned from Europe in the late 1860s, the American economy looked like a giant steel engine grinding against itself. Railroads, then nearly 60% of the entire U.S. stock market's value, were the arteries of commerce, but also its greatest weakness. Hundreds of small competing lines undercut each other's freight rates just to stay alive. Bankruptcies were routine. Investors lost faith. Morgan's great insight was simple, yet radical chaos destroys profits. But order creates wealth, rather than merely lend to desperate railroad barons. He started buying the lines outright, merging rivals, standardizing track gauges, cutting redundant routes. This new way of taming an industry became so famous it earned its own name, Morganization. What began as a rescue mission for failing tracks soon became a playbook for building empires, and Morgan was only getting started. By the 1880s, he had reorganized carriers like the Ohio and Mississippi and Illinois Central, turning them from loss makers into steady earners through tighter cost controls and centralized scheduling. By the turn of the century, railroads under his sway controlled one-third of all U.S. track mileage, a steel and steam empire stretching from the Great Lakes to the Gulf of Mexico. Seeing the supply chain as one living organism, Morgan moved upstream into steel. Railroads needed stronger rails. Bridges were rising over rivers. New skyscrapers demanded beams and girders. In 1901, he struck one of the most dramatic deals in American business, the $480 million purchase of Carnegie Steel. Merging it with Federal Steel and others to form the U.S. Steel, the first billion-dollar corporation, worth $1.4 billion, and commanding as much as 70% of the nation's steel output. Steel had made Morgan the master of America's backbone, but he was already eyeing the current that would light its cities. In 1892, he orchestrated the merger of Edison General Electric with Thomson Houston, keeping Thomas Edison's dream alive long enough to light the streets of New York and eventually much of the industrial world. He also became famous for buying when markets bled. During the Panic of 1893, while weaker investors fled, he quietly acquired bankrupt rail lines at bargain prices and rebuilt them for profit. During the bankers' panic of 1907, with the banking system on the brink, Morgan locked rival financiers inside his private library until they pledged enough capital to stop the run on the banks. That single night of private intervention steadied the markets and cemented his reputation as America's unofficial central banker. Yet the same iron grip that rescued markets would soon alarm presidents and spark a national backlash. The architecture of Morganization was as disciplined as it was bold. Morgan believed capital had to be consolidated, restructured, then professionally financed a triad that inspired future private equity models. He personally sat on the boards of his investments, replaced executives he deemed wasteful, and enforced tight fiscal standards in the reorganized rail networks. Rationalized routes and fixed pricing turned cutthroat competition into predictable returns of 8 to 10%, restoring investor confidence and pulling in European capital for America's industrial boom. But with every mile of track and every ton of steel he controlled, public suspicion grew, and the age of the robber baron was about to collide with the age of reform. Flagship deals under Morgan's hand reshaped the nation, his $250,000 share stake in the New York Central from the Vanderbilt family, the record $40 million Northern Pacific bond issue, the restructuring of the Southern Railway, and the New York, New Haven, and Hartford each helped knit the continent's transport grid. The 1901 Carnegie Steel buyout turned scattered mills into a corporate giant that built bridges, battleships, skyscrapers. The 1892 birth of General Electric ushered in the electric age for American homes and factories. These weren't just profitable ventures, they redrew the map of U.S. commerce, fueling urban growth from Chicago to Pittsburgh and electrifying entire regions. Morgan's influence reached deep into Washington and London. In 1895, as America's gold reserves fell to a perilous $9 million, he brokered a $65 million gold bond rescue with European partners, stabilizing the treasury in just 22 minutes. Such feats won him gratitude from presidents, yet also fierce critics who accused him of wielding king-like power. By the dawn of the 20th century, Morgan's signature was stamped on the nation's railroads, steel beams, and electric grids. But that concentration of power, the very force that built modern industry, would ignite public outrage, trigger courtroom battles, and plunge the Morgan Empire into a new era of scandal. By the turn of the 20th century, J.P. Morgan was no longer just a banker. He was the most powerful private citizen in the United States. His signature alone could move markets overnight. His phone call could decide which railroad survived, which steel mill shut down, even which banks would live or die. To millions of Americans, he looked less like a financier and more like a monarch of money, a towering figure whose broad shoulders and the infamous red, bulbous nose he hated came to symbolize both the strength and the threat of concentrated wealth. Morgan's political clout was born in moments of national peril. In 1895, as the Treasury's gold reserves collapsed to a perilous $9 million, threatening the dollar itself, President Grover Cleveland's administration didn't summon Congress first, it summoned Morgan, with a few telegrams and a lightning-fast meeting in New York. He pulled together a syndicate of European investors and, in just 22 minutes, guaranteed a $65 million gold bond rescue. The deal stabilized the U.S. economy overnight. For the first time, the public saw what insiders already knew: a single banker had effectively bailed out and profited from saving the American government. That night proved Morgan could do what Washington could not, and it made him both indispensable and deeply feared. Aligned with the pro-business Republicans and a supporter of President McKinley, Morgan still found his influence colliding with Theodore Roosevelt, the trustbuster who vowed to rein in the titans of industry. The confrontation climaxed in 1901 with the creation of the Northern Securities Company, a Morgan-backed railroad holding that spanned the continent. Roosevelt's Justice Department sued under the Sherman Antitrust Act, and in 1904, the Supreme Court ordered the company dismantled. It was a historic antitrust win, but also a warning shot to the man many now call the Czar of Wall Street. Morgan, stung by the defeat, reportedly scoffed, "If we have done anything wrong, send your man to my man and they can fix it up." Yet even the president who humbled him would soon be forced to rely on Morgan's iron grip when the banking system itself began to crack. In the panic of 1907, when waves of bank runs threatened to freeze the nation's entire financial system, there was still no central bank to step in. Once again, the country turned not to Congress, but to one 70-year-old man, inside his Madison Avenue library. Morgan locked the oak doors behind New York's top financiers and refused to let them leave until they pledged millions in emergency credit. By dawn, the panic was contained. The rescue cemented his image as America's unofficial central banker, proof that, for a critical night in October 1907, the U.S. economy was literally governed by Morgan's will. The drama also convinced lawmakers that the Republic could not continue to rely on a single private citizen as its financial fire brigade. 6 years later, the Federal Reserve System was born 1 year after Morgan's death. But that same dominance fueled fears of a money trust. The outcry reached its peak in the Pujo Committee hearings of 1912, where a visibly frail Morgan defended his creed. A man's character, not collateral, is the true basis of credit. The line impressed some, but hardly erased the suspicion that one man had been more powerful than the U.S. Treasury itself. Friends said the hearings drained him. He appeared gaunt and depressed. He died the next spring in Rome, leaving an estate of about $80 million, a modest sum compared to the fortunes he had steered with the stroke of a pen. Even in death, the question lingered, had Morgan been the guardian of American capitalism or its master? His legacy of command would echo a century later, under CEO Jamie Dimon. The modern J.P. Morgan Chase inherited that instinct to dominate in crises, acquiring Bear Stearns for $2 a share during the 2008 meltdown, absorbing Washington Mutual, and paying tens of billions in fines for mortgage and trading scandals. Critics saw a pattern as old as Morgan himself, private power profiting amid public pain, while supporters argued the firm once again had stabilized markets when others failed. Through it all, the Morgan name remained shorthand for authority above politics power that could steady markets when governments faltered, dictate mergers that reshaped entire industries, and provoke outrage for being too indispensable to ignore in an age before the Federal Reserve. J.P. Morgan was not merely a banker. He was the nation's backup government, a man whose pen could rescue the dollar, reorder industries, and remind a democracy that capital itself sometimes wears a single face. More than a century after J.P. Morgan's death, the dynasty's influence hasn't faded. It has evolved, where the founder once presided over a mahogany-paneled library in Manhattan. Today, Jamie Dimon leads the modern incarnation of the empire from glass-walled boardrooms overlooking New York's skyline. Dimon, who became CEO of J.P. Morgan Chase in 2005, has guided the bank for 2 decades through some of the most turbulent chapters in global finance, earning a reputation as both a crisis firefighter and a relentless competitor. Unlike the flamboyant billionaires who dominate headlines, Dimon cultivates an image closer to the old-school Morgan ideal: discipline, hard driving, and publicly restrained. His personal fortune now stretches into the billions. Yet he is better known for his long hours, sharp analytical style, and willingness to challenge Washington policymakers. During the 2008 financial crisis, while other banks wavered or crumbled, Dimon's team acquired the collapsing Bear Stearns at a fire sale price and absorbed Washington Mutual. Moves that transformed J.P. Morgan Chase into the largest U.S. bank almost overnight. Those acquisitions, echoing J.P. Morgan's own crisis-era rescues a century earlier, were hailed by some as acts that steadied the markets even as critics accused the bank of profiting from the panic. Under Dimon's leadership, the institution has continued to grow on a global scale. Since 2018, the bank has opened over 1,000 new branches across the United States, expanded deeper into European markets, and poured billions into fintech, AI-driven trading, and digital banking platforms, aiming to future-proof the empire against a rapidly shifting financial landscape. Supporters describe Dimon as a pragmatic modernizer who blends technology with the conservative risk culture that kept the bank comparatively stable during crises. Detractors counter that his aggressive expansion and cost-cutting tactics, including mass layoffs after mergers, mirror the very consolidation that once made J.P. Morgan himself both admired and feared. The bank's philanthropic footprint has also grown through J.P. Morgan Chase Foundation initiatives. Dimon's tenure has channeled hundreds of millions of dollars into small business lending in underserved neighborhoods, workforce skills training, community development, and environmental projects. In speeches, Dimon has urged corporate America to address income inequality and economic polarization. Still, many activists and watchdog groups argue that such programs, however significant, are dwarfed by the scale of the bank's profits and do little to offset its continuing dominance in global finance. The tension echoes the paradox of the original Morgan legacy: genuine contributions to public good, weighed against the perception of entrenched corporate power. The influence of the Morgan institution on cities and economies remains unmistakable. From underwriting the railroads that built America's industrial heartland to financing urban redevelopment projects and technology startups today, the firm has helped shape skylines and labor markets for over 150 years. Economists note that decisions made in the bank's New York headquarters still ripple through credit flows, housing markets, and investment strategies worldwide, an enduring reminder of how private capital can steer public outcomes. For historians, the dual legacy of the Morgans remains a subject of debate. On one hand is what admirers call the golden legacy driving industrial progress, rescuing the U.S. economy during crises and modernizing the global banking system. On the other is the shadow legacy accusations of monopolistic power, widening social inequality, and the recurring suspicion that the institution thrives most in times of turmoil, in Jamie Dimon's era. These twin narratives continue to collide, every strategic triumph tempered by billion-dollar fines or new investigations. Today, as J.P. Morgan Chase stands as the world's largest bank by assets, the story of the Morgans is no longer just about one man's fortune. It has become a saga about how private finance can both stabilize and disrupt the societies it serves. A story that stretches from the iron rails of the Gilded Age to the cloud-based ledgers of the 21st century. For more than a century and a half, the Morgan name has hovered like a watermark over America's economy, sometimes visible in bold relief during crises, other times fading quietly into the background of everyday finance. The same institution that once stabilized the gold reserves of a fragile young republic now moves trillions across global markets at the speed of a keystroke. From the mahogany paneled library where JP Morgan locked rival bankers in until they saved the markets, to the digital trading floors where Jamie Dimon's team deploys algorithms to manage risk in milliseconds. The story has always carried a paradox: private power stepping in where public systems falter. To admirers, the Morgans were and still are the firefighters of capitalism, willing to throw capital into the flames when others hesitate. To critics, they represent the uncomfortable truth that some of the greatest profits in finance are made precisely when the world is burning. The influence of this dynasty reaches far beyond ledgers and stock tickers. It shaped the rise of the railroads that stitched a continent together, built the steel that framed its bridges and skyscrapers, and bankrolled the electric grids that lit its streets. Yet the same concentration of power provoked antitrust crusades, congressional hearings, billion-dollar fines, and decades of public suspicion. Every generation seems to wrestle with the same question: can a democracy tolerate so much economic influence in private hands, or does it sometimes depend on it? As viewers step back from this 150-year journey, the Morgan saga invites reflection on our present moment. When the next global crisis strikes, will we once again rely on giants of private finance to step in, or should that responsibility rest solely with governments and central banks? And if the reach of this institution continues to grow, what kind of balance between innovation, profit, and accountability will the future demand? What do you think? Has the Morgan Empire been a stabilizing force safeguarding the economy? Or has it become a barrier to fairness and competition? We'd love to hear your thoughts in the comments below. And if you'd like to keep exploring the untold stories behind other industrial dynasties, check out our next documentary on the Rockefeller oil empire and see how another name shaped the fortunes and controversies of an entire century.